Thank you. I'm excited to be back up here with two longtime financial health leaders, Arjit Roy and Ben Mankey. I'm going to give them a chance to introduce themselves in just a moment. First, let me tee up what we're going to talk about. Yesterday, you heard me talk about all of the various disruptions we're facing and the fact that we really have to examine our operating models. We can't assume that our operating models can stay the same given the way the world is changing. So one of the things we have to do is really question what we have heretofore known as best practices. And so that's what we're going to do today. We're going to spend a little time talking about what our customers and workers are facing, whether the current playbook and best practices are working, what new things might be working instead, and how you ultimately scale these kinds of initiatives within very large companies. Sound good? Okay. Hello, Arjit.
Hi,
Hello,
Jen.
Ben. So I would love for each of you to introduce yourselves. You know, tell folks like what you take care of every day, but tell them a little bit about who your customers are, who you're serving, how many. Put a little face to it. And as you do that, I'd love for you to reflect on what I talked about yesterday in terms of those three disruptions about how people work, how they get ahead, how they engage. How is that manifesting for your customers or your workers? Or are you seeing different challenges or opportunities? Arjit?
Oh, I was going to pass the buck.
Either way, right?
Ben, why don't you start?
Thank you. Hello, my name is Ben Mankey. I lead our financial health strategy at Amazon. We like to say it's day one at Amazon. It still feels like day one. Everything's always changing all the time. We've been at this work for 4 years, but we're just starting to really scratch the surface. Our employees are as diverse as the United States. We have people of all ages, all job types, everything from frontline warehouse work to engineers building satellites, engineers writing software, entertainment and movies. So it gets more diverse every day, but it's a great mix of employees. Again, really shows the same kind of characteristics as the entire country, which is fun, but also really difficult to solve for.
And how many?
1.2 million in the US, and then another 300,000 to 400,000 globally. And we're in about 60 countries, going to probably 65 or 70 by the end of this year.
And in the last few years, what are you seeing that your workers are experiencing that they might not have been experiencing before?
Yeah, when we first started as a team 4 years ago, we got some aggregate credit scoring data across our entire population. And at that time, it was the middle of COVID. There was a lot of stimulus money going around, and things, weren't perfect, but they weren't necessarily terrible. We just ran the same study again about 2 or 3 months ago, and things looked a lot different. And it wasn't just frontline, low to moderate income workers. It was across the board. And so we are internally influencing our leadership to understand that it's not about how much you make. Sometimes a bigger shovel means a bigger hole that you dig yourself into, or that life can throw at you curveballs. So we are looking at how to address that. All of our benefits are day one, and they apply to all of our population. So that's one of the great things about Amazon is whether you're in the C-suite or you're on the front lines, you have the same exact benefits.
Got it. Thanks, Ben.
My name's Arjit Roy. It is a real privilege to be with you and in this conference. I lead the consumer and business banking products team at US Bank. US Bank is the 5th largest bank by assets in America. We are a coast-to-coast franchise in 26 states. We serve 13 million consumer clients, 8 million deposit clients, about 2 million lending clients, and we also serve about 1,300,000-ish businesses, all the way from businesses that are sole props making $0 in revenue, so someone with an idea, all the way up to $50 million in revenue. So we've sort of seen the gamut. And we have watched the last few years quite curiously, and I'll lead into a question you asked. You mentioned yesterday about the general sentiment and how it's feeling a little untethered, not a word that you used, but I'm summarizing. You talked about the K-shaped economy. You talked about how there's a difference in how different folks are experiencing America and the world. And what we're seeing in our base across the 13 million clients that we serve is actually not that much of a change in behavior. We're not seeing differences in spend patterns. We're not seeing differences in what they're thinking about for the future, but we're seeing a change in sentiment. The level of optimism has come down, and it doesn't matter what rung of the K you're on. Even if you're on the upper end of the K, you're one stock market wobble away from your financial health getting blown up. And if you're in the bottom rung of the K, you all know the statistics, you know the stories. And what we're starting to watch for is when the sentiment changes into actual behavioral changes, which hasn't happened yet. And who knows if that is a story of American exceptionalism? Who knows if that is a story of resilience? Who knows if that's a story of underlying financial health actually having gotten better, where they're able to withstand shocks like Hormuz or tariffs and live to fight another day?
So I read that a lot of what's keeping the bottom half of the K afloat is debt. Are you seeing that at all? More debt is what's enabling people to keep spending at the same levels?
We're not seeing it in the drawing down of lines. We're not seeing it in balances and average credit cards go up. What we are seeing is a change in how people stay with their jobs. You talked about the gig economy having picked up, and so incomes are flat. And by the way, Ben talked about COVID. We for sure are seeing the differences in people's average balances on their savings and checking accounts. You saw this run up with stimulus, and that money has been sucked out, especially in a higher for longer interest rate environment. There is a lot of rate seeking going on, and so checking balances are down. People are trying to park more balances in higher yield products. But what we're seeing is the nature of the debt changing. And so where it was de rigueur for someone to save up, put a down payment, and chase the American dream by buying a home with a mortgage, that is being postponed. And so FICO levels are roughly the same, but people aren't getting into homes. Now, it's not an indictment on their financial health. It's actually a structural outcome of what's happening with the mortgage market. Supply plays a role in it. Mortgage rates play a role in it, which actually run separately from what the Fed's doing. And so we're not seeing distress, we're seeing different usage of debt.
Interesting. Arjit, let's stick with you for a minute. You've been on this financial health journey for a while now.
Yeah.
What is working, do you think?
I think acknowledgement that for the first time in the history of banking or in financial services, banks serve 5 different generations at the same time, and not approaching the marketplace through a one-size-fits-all approach is actually working. There are many folks in the audience here that have a Gen Z or 2 at home, maybe a Gen Alpha or 2 at home. And for those Gen Z, Gen Alpha clients or future clients, they're not thinking about their engagement with the financial ecosystem by walking into a bank branch on their college campus and asking for a book of checks, or walking into a credit union. Things that I did, by the way. I'm dating myself. Checks are still a thing. Walking into a credit union and asking for an auto loan and getting the book of payments. I mean, for those of you that aren't familiar, in the late 1990s, you would get a book, and you would actually have to write a check out and mail it in. It's very different. And
Maybe we
back
should explain the telephone.
correct.
While we're at it.
You used to have to use a phone that you would have to open and press multiple times. I mean, I explain this stuff to my kids, and they think it's a dad joke. It is not a dad joke. And I think the ability for the financial services system, the ability to serve across multiple centuries really and adapt to that is actually working. And so the best institutions are those that can find that relevance across those 5 generations and adapt their product offering, think about evolving how they equip their frontline employees and their workers to serve someone who's walked in because they're elderly and they've forgotten a password, or they're a business owner because they are looking for cash and coin on a Friday, or a teenager that wants to set up a Greenlight account. And that is it's an example of resilience in the financial system that's adapted quite well to this generational shift.
Thank you. Ben, what about you? What's working?
I think in the last 4 years, I've seen a huge shift among employers. There's a recognition that the old goal of let's just get our people to retirement and that's our responsibility has changed a lot. And I heard it spoken best by the CEO of Commonwealth, Tim Flacca. He said, the model isn't get people to retirement. The model should be we need to help get people to Friday, and then the next week, the next month, the next year, and so on. And that's what I'm seeing and hearing from others in this space is that leadership's minds are shifting and there's a recognition that we need to do more to help people. We do live in the United States where some of our founding principles were, pull yourself up by your bootstraps, and there's other common phrases like that, but there's also recognition that not everybody has bootstraps. Some people do, some people don't. We don't start off on the same footing. We don't have all the same circumstances. Personal finance is personal. So as employers, we are looking to provide our employees with bootstraps and then to reach out to them and help pull them forward to meet their goals and the things that they want to accomplish in life. So that has been very heartening to me. I will also say that there is a lot of work being done at banks, credit unions, fintechs to provide solutions to employers like us. It's amazing to see what has come out of incubators from innovators and all the different solutions covering the wide variety of financial services. So I love to see more of that. I wish there was more of that globally. The US is definitely leading in this space, and we're very thankful for that. But that I think are the 2 big things that I've seen.
So interestingly, I haven't heard either of you use the word trust. And I only raise that because according to every survey, all the numbers, there is a dearth of trust in institutions of all kinds. And even among trust in one's employer, which tended to be like the one that was remaining above water, looks like it has taken a hit also. What can you say about trust levels, how that's changing or not, and what you're doing or what you do to try to make sure that you're earning that trust?
One of our leadership principles is customer obsession, and that's not just externally to our external customers, it's internal as well. So everything that we do is built around the trust of our employees, and within the benefits space at least, employees do trust us with what we're bringing forward. They trust us to find the right solution, the right partner, who's going to do the right thing every time for them. So we've been fortunate that employees look at us in that way, and we seek to maintain that as long as we can. As Warren Buffett said, it takes years to earn trust, but only 5 seconds to lose it. So we're fortunate to be in that position, and I think financial institutions are as well. People still trust the system. I know there's some younger generations that may look at things a little more skeptical, but I think that might just be time required. In time, you learn more about different institutions and their track records, their history, and our system is one that I think is trustworthy.
Yeah, I agree with you, Ben. I think what I really liked in your example is this notion that trust is earned every day, every transaction, every client at a time, and it can take you millions and billions of correct interactions, and if something goes awry, it's very easy to lose that trust, and that is the standard we hold ourselves to. look, there's so much ink has been spilled about this new generation of entrepreneurs trying to make a splash in the financial health space or in the financial services space. Do you really want the ethos of move fast and break things driving people's financial health in their lives? I don't think so. I mean, would you feel that way with your own personal health? I don't think so. And so I think the opportunity to earn that trust every day is something that we strive to provide and we strive to work on. There's work to be done. We were talking about robotics and engineering, and you can put a mathematical number on it, and you can say 6 sigma, 5 nines reliability, and that's unfortunately not the way that things work. They should, but they don't. And I think the opportunity for large and small players, your credit union or a local community bank or a large institution, is to try to make sure that if there is an opportunity or if there is a situation where you're about to break trust in that relationship, that secret relationship, that's where maybe it's human judgment or human intervention that can help regain some of that trust. And I think that's what we strive to do. Beware the law of averages. Beware the law of FICO bands. And to the extent that we continue to strive as an industry and think about ways that we show up for our clients, that's what will make a huge difference in how they put their trust in us.
Let's get a little more tactical, because I know people here like to hear about what's actually happening, what you're actually doing. Ben, talk about one thing you're doing or have been doing specifically that's working, and how do you know it's working as it relates to improving the financial health of your workers?
One of the big things is having a human available to connect on a personal level with our employees. We have a financial care benefit, which most employees find it through some kind of financial hardship or urgency. And it's proven to result in quite a large increase in financial health, because once they solve that urgent need that they have, they're working on an average of 4 to 5 different issues with that financial assistance. Like having a Jake from State Farm, to invoke some pop culture references. They're there to listen, they're there to help you, they're empathetic, they understand your situation, and they're there to encourage you and walk through it with you. So I don't think that will go away anytime soon. As much as I think AI is going to be a great tool that will endure for a long time, AI does not have empathy. It doesn't have a soul. It wants to make you happy, and it will give you all the good words. Even if you're mean to it, it will still be nice to you. And that's not, that's not empathy. That's not a person. So I think having a human there.
It could be a good boss.
It could be a good. Having a human there has proven to be really, really great. And then the use of AI as well. To bring solutions to employees, to the right employee at the right time. We're not just mass marketing our benefits to employees anymore. We are leveraging data that we have. We have a lot of data on our employees. We know who's having children, who has a garnishment, who may be financially struggling based on their hours dropping or their income going down, going on a leave of absence. So we can really share our benefits with the right employees and make sure that they're being utilized by the people who need it most.
So your partner there on the front end that you mentioned is, I believe, Brightside.
It is.
And I have to mention them because they are a graduate of our Financial Solutions Lab. And so we're very excited about them. Can you say more about usage levels or how you know that's working?
Absolutely. So one thing about Brightside, another good thing about Brightside, is that they are a provider of providers. As a benefits manager, it is difficult to form a large body of solutions for our employees and maintain those. So one great thing about Brightside is they form partnerships, and so we don't have to manage that relationship. The financial assistant is there to direct the employee to the right benefit provider that they have or to one that we have. So in looking at what they do, they move people from a place of financial instability oftentimes to a place of financial stability. Not everybody reaches out to them for instability. Some people just want help budgeting, or they want to plan for their future. or they want help selecting a medical plan. Brightside Financial Assistants can review the options, understand the employee's context, and then advise on what might work best for them. So we measure money returned back into their pockets through refinancing at lower rates, avoidance of high interest loans, things of that nature. We look at utilization, and utilization is one metric that doesn't tell you the value being provided, but as I mentioned earlier, 4 to 5 different issues being addressed per employee tells us that employees' lives are complicated and they're all getting addressed because a person is there to understand their context and talk through those potential solutions with them.
Got it. All right, Arjit, your turn.
We've had the great fortune of partnering with you for over a decade, I think. And I know that the relationship has evolved over time to being an advisory relationship to now where you're actually in the muck with us. And some of the work that you've helped us guide with how we're thinking about starter products, how we're thinking about a potential pilot in the branches with humans to avoid check cashing. These are puddles that we hope will one day become tsunamis. And so you try and test a bunch of different things. We've been fortunate to pick up some of your talent. And so,
Yes, you have.
As have we.
Thank you.
You're welcome.
And so our ability to have these relationships, you mentioned Tim Flocka and Commonwealth, they've been an advisor to us as we've talked about tax time and how to think about maximizing folks and the largest check that for many of our clients will be their tax refund, and how to better utilize it and think about that as being a catalyst to start with savings. And so our surface area is quite broad, and we expect to drive scale out of a lot of this experimentation. And so we're very fortunate for partners like you and Commonwealth and the Aspen Institute, and we'll keep tinkering in this space.
So as we wrap up, I'd love for the two of you to reflect on the second part of what I talked about yesterday, which was about providing workers and customers with clarity, pathways, and trust. We've talked a little bit about trust. What do you think the next set of best practices need to look like? Mm-hmm. Or what themes should they address? Right, I don't expect you to have written the future yet, although if you have, bonus points to you. But as you're looking to the next hill to climb, in the context of the world we're living in, where do you think we need to be aiming?
I think we're living in an interesting time where you brought it up.
For sure.
You brought it up during your opening remarks about financial nihilism. There's a lot of folks on social media saying a lot of things. Some of them are correct, some of them are not. The news media is obviously working to get attention, and so there's a lot of negative sentiment out there. And so it's tough watching the youngest generation struggle through the things they're struggling through. I am an elder millennial, so I came out of college right during the financial crisis. I have confidence that the younger generations will make it through just as we have and generations before us, but I think the value of ownership in the economy, whether it's through housing, whether it's through investments, we need to make owners, we need to make people feel like they own something. Just more broadly, I'm a local government elected official in my city, and we see a lot of political polarization when people don't feel like they have a stake in their community or a stake in the system. You get like people farther to both ends of the spectrum, you get less community investment. And so as a country, I think it's important for all of us to get people into the system, trusting the system as owners in the system, so that we can build strong communities, strong financial health in those communities and within our families.
And what role do you think employers should be playing in that? Are you gonna give everyone some stock options maybe? Or I'm just curious.
Yeah, within the benefit space at Amazon, we like to debate things hotly. We like to we call it disagree and commit. It's one of our leadership principles where we hotly debate a topic, and then once it's determined, we all commit to going forward. And we want to present a wide range of solutions to our employees to help them better their lives if they so choose to do so. We can't force anybody to do it, just like we provide mental health resources. We can't force anybody to take and use those benefits, but we do see ourselves being a national company, global company. The things that we offer to employees do impact their local communities. It's not just them and their families, it is their communities. So we do have a stake in that, and we do think about that as we launch solutions.
That's a good point. I'll just ask you briefly, what else does Amazon do sort of from a place-based perspective that may not be directly delivered through the worker, but might benefit the worker? Like some companies, for instance, help build housing in a local community or help finance the purchase of homes. I kind of dished on home ownership yesterday quite a bit, maybe more than I intended. And that's not the only way to invest in one's local community, but how is Amazon thinking about that?
Sure, we do have a housing fund, a quite large housing fund that has been going to locations where we have a large physical presence. We know that bringing employees to those locations causes prices to go up and displaces, so we're trying to build affordable housing, partnering with government agencies that have excess land. In the Seattle area, there's a big transit expansion, and so the transit agency had a lot of staging sites, and so we were able to contribute toward affordable housing in those places. We also have an Amazon Relief Fund, which is not for our employees, it's for the communities in which we serve or we have large operations buildings. And then within each operations building, there is a budget that employees can use to serve their community in the way that they feel most connected to. So tens of thousands of dollars are given away from each building every year based on the employees' desire to give to their communities.
Got it. Thanks for sharing. All right, Arjun, bring us home.
I'm an eternal optimist. I know that you sort of set the stage and stirred the pot and got everybody afraid, you know.
You're both very agreeable.
I'm optimistic because the next frontier in banking and financial services through the client lens, not the employee lens, is about injecting a little bit of empathy in what banks do and applying it to better understand context of what clients are facing. And so within the walls of US Bank, we don't have a lot of leadership principles, by the way. We just get to work, you know. But we talk about stuff, and we also debate stuff. And so what we describe is this notion of the 5 Ds. We talk about diamonds, diapers, divorce, downsizing, and death. And it sounds dire, but if you're able to sort of... Also D. But if you're able to figure out that a client is going through one of those Ds, and if you're able to show up empathetically, if that branch frontline employee is able to recognize that in a period and do something about it, that's the empathy component of it. And we're seeing examples of this all over. And that's why I'm optimistic. And I think if we're able to get our organization and our broader banking ecosystem to meet that moment, there's no stopping how we deliver on this promise of trust.
So I'll push you one more time before we end. We've had this conversation, you and I. You've got a lot of new competitors.
Yes.
In the world. Are banks more uniquely or better positioned to deliver that empathy, do you think?
Yes. Without question, an app or a fintech company, as wonderful as they are and as essential as they are in getting banks to think about delivering simplicity and client experience better, we're very grateful for them showing us how to build a better app and how to cut to the heart of it. But there's a reason you hear about fintechs now looking for their bank charters. Why do you suppose that is? Why do you suppose it's interesting to still have a conversation about the importance of branches? Yes, stablecoin, yes, AI, yes, fintechs, yes, big tech. But at the end of the day, a bank serves a very basic need in people's lives and community. And there's very few examples, at least in America, where you've been able to provide that service helping people save money and providing access to capital to help fulfill what their dreams and purpose is. Very few other players can actually fulfill that to the extent, and the piece that's the ultimate deliverer of that promise is the human in the middle. Not human in the loop, but human in the middle. And so that's what makes banks different.
So we didn't mention when we introduced Arjit that he is also the new chair of the Consumer Bankers Association. So now you can say that you also wore that hat on this stage. I'm going to leave it there, but thanks to both of you. Help me thank our fantastic panelists.